Buying your first home should be one of the most exciting things you ever do. But for most people, it's actually pretty scary. And to be honest, it's not entirely their fault because nobody teaches you this stuff. You just kind of expected to figure it out along the way. But today, we're going to change that. This is a deep dive through the entire first home buyer process step by step so that when you buy your first home, it actually gets to feel like the milestone it's supposed to be. If you're new here, I'm Chris Moore. I'm a mortgage broker and I've settled well over 200 million in home loans and was recently named Australia's New Broker of the Year in 2024. Now, I want you to treat this video like a course, so grab a notepad and a pen, use the chapter markers to skip forward and pause wherever you need to, and let's dive in. Before we get stuck into the numbers, let's talk about mindset, because most people delay buying a home for years simply because they assume they can't do it, without ever actually running the numbers to find out if that's actually the case. And something I say to every single one of my clients is a roadmap is no good unless you know where you are now and where you're trying to get to in the future. So if property ownership is the destination and we know what your starting point is, all we need to do is map out the path for you, even if you're not quite ready to go yet. So the first question I want you to ask yourself is, why do I want to buy a home? Is it about stability? Is it about building equity rather than paying rent? Perhaps you're looking to start a family. Knowing your why helps keep you motivated through the moments that are going to feel hard, especially if you're balancing trying to save for a deposit whilst battling the rising cost of living. But if you can tie what your why is to the end goal, it's going to give you far more motivation to keep going. The starting point for all first home buyers is actually understanding what government benefits you're entitled to, because they actually vary state to state, and they'll vary depending on whether you're looking to build or whether you're looking to buy an established property. There are actually two main types of government support. The first is the first homeowner's grant, and this is a one-off cash payment of between 10 to 50 grand depending on your state, and is generally paid directly to you at settlement. Now, it's important to note that this grant applies to new homes only, so newly built, off the plan, or substantially renovated. So if you're looking to buy an established home where you're not the first owner, you generally don't qualify. But the good news is you may still be eligible for the second type of support. And the second type is what's called a stamp duty concession or 100% stamp duty waiver. Now, if you're not quite sure what stamp duty is, it's just a government tax which is calculated on the price of the property that you're looking to purchase. But because of this, it's actually one of the most expensive costs when you look to purchase a property. But unlike the first homeowner's grant, it applies to both new and existing homes. And depending on your purchase price will determine whether you're eligible for a 100% waiver of the cost or whether a concessional rate will apply. On screen now, you can see the full state-by-state breakdown. So pause here, find your state, and take note of what you're entitled to. I've also included a link in the description to a stamp duty calculator so you can see your savings as well. Now, these numbers can mean anywhere between a 10 to over a 30 grand saving before you've even started the process. On top of the state entitlements, there's also 3 federal schemes available nationwide. And the first is called the 5% deposit scheme, or what used to be called the first home guarantee scheme. And this allows you to purchase with as little as a 5% deposit without needing to pay what's called lender's mortgage insurance. The government effectively guarantee the other 15% of your deposit, bridging the gap between the normal 20% lenders normally require. And the good news is the income caps were actually removed in October of 2025. So more people than ever are actually now eligible for this. You do need to be an Australian citizen or a permanent resident, and just be aware there are some purchase price caps in each state you need to stay under to remain eligible. The second is the First Home Super Saver Scheme, and this allows you to make voluntary pre-tax contributions at a 15% tax rate, rather than your marginal tax rate of 32.5% or higher. And it allows you to withdraw up to 50 grand of those contributions towards your deposit. If you're looking to buy with a partner, you can each access 50 grand, giving you $100,000 combined. It's one of the most tax-effective ways to grow your savings quicker by taking advantage of the lower tax rates with your super fund. The third is the Help to Buy Shared Equity Scheme. The government contributes up to 40% of the purchase price on a new build or 30% on established home in exchange for an equivalent equity share. You end up borrowing less, your repayments are lower, and then when you sell, the government takes its proportional share. It is more strictly means tested, but for the right person, it can help them get into a property sooner. But here's what most people don't realize, is that these schemes can actually be used together. So you might qualify for the first homeowner's grant, a stamp duty concession, the 5% deposit scheme, and the First Home Super Saver Scheme all at once. That combination can save you tens of thousands in upfront costs before you've made a single repayment. Now, just be aware, these figures are current as of April 2026, but they do change from time to time. So always verify with your state revenue office or with your mortgage broker before you look to do anything. Most people are aware they'll need some kind of a deposit, but what are the other costs of buying? So the standard deposit is generally around 20%. The banks love it when people borrow with a 20% deposit. So assuming a $700,000 purchase, that'd be around 140 grand. But as we just covered, you don't always need a 20% deposit. So if you're applying under the 5% deposit scheme, you'd only need 35 grand on that same purchase. If you go in with less than a 20% deposit outside of a government guarantee scheme, you'll likely have to pay lender's mortgage insurance, which is a one-off insurance premium that protects the banks, not you, and it just gets added into your loan. The second is stamp duty, and we did cover this in chapter 2, but it belongs here as well, because to be honest, it's one of your biggest upfront costs. And depending on the state and your price point, it could be as little as $0 or over $20,000. So make sure you know what this figure is, because you do need to pay for it upfront. The third is the cost for a conveyancer or a solicitor, and this can be anywhere from $1,500 to $3 grand. And they are the legal professional who handles the transfer of ownership. They help review the contract, conduct searches, liaise with the vendor's legal team, and help manage your actual settlement. They will also help calculate any council and water rates adjustments that need to be paid at the settlement. Unfortunately, this is not an option, so make sure you ask your broker if they do have anyone that they can recommend. The next is building and pest inspections, and the cost will cover a licensed inspector to go out, assess the structure of your property to see whether there's any building defects or any pest issues that you need to be aware of. Anything structural in nature will be flagged in the building report, and you'll actually have the opportunity to go back to the vendor to make good on the repairs or to be able to negotiate a cost reduction to cover the cost to repair the issues. One that often gets forgotten is costs of removalists, and this can be anywhere from $500 to over $3 grand depending on how much you have to move. Now, no one likes moving house, so if you are looking to use a removalist, make sure you get a quote early on so you can factor that into your numbers. It goes without saying, but obviously home ownership does come with some ongoing costs from day one. Things like council rates can be up to $2.5 grand a year, water rates between $800 to $1,500 a year, and building and contents insurance can be anywhere from $1,500 to a few grand a year. And if the property you purchase is a house, you will need building insurance required at settlement. Lastly, if you've purchased in a strata complex, make sure you factor in quarterly levies of between, again, $500 to $2,000 a quarter, depending on the building and the amenities that your property has. So with all this in mind, let's look at an example of a first home buyer couple who are looking to purchase an established home in Western Australia for up to $650,000. Well, first of all, let's say they apply under the 5% deposit scheme. 5% would be $32,500. They're eligible for a concessional rate of stamp duty as their property is between $500,000 to $700,000 as the purchase price, but the cost of the stamp duty inclusive of the government fees is going to be another $21,008. If we allow another $3 grand approximately for conveyancing costs and adjustments and another $500 for building and pest, this brings the total funds required to $57,008. Now, this is really important to note because this is the figure that you're going to need to be budgeting your saving goals towards, not just the 5% deposit. Before you do anything else, you need to make sure that your credit score is in order. You can basically think of this like a snapshot of your financial history over the last 5 years. Every single account you've opened, every payment you've made or missed, every default and every inquiry all in one place. It's essentially a financial track record, and lenders use it to assess if you present any risks or red flags in lending to. What a lot of people don't realize though is that most banks use an automatic credit scoring system. The moment your application is submitted, it can actually be instantly declined before humans even picked up your file to have a look at it. So just because you're on a great income, you've got a solid deposit, this won't actually save you if something on your credit file triggers a decline. Now, to be clear, as a matter of process, I check every one of my clients' credit reports before we submit any applications to avoid this exact scenario. But if you want to do the same thing, you can actually access your own copy of your credit report for free every 3 months via Experian or Equifax. I've included the links down below in the description. So you've got your credit report in hand, but how do I actually interpret this information and what are the banks actually looking at? Well, firstly, your entire credit report can often be summarized by your actual score itself. To put it simply, the higher the number, the better. And as a general rule of thumb, anything over 800 is considered strong. Between 600 to 800 is good. Anything below this may be a cause for concern, and we really want to understand why and what has caused this to happen. The next thing to check is your credit inquiries, because too many credit inquiries in a short space of time, especially for things like credit cards and short-term payday lenders, are often a sign that someone is living beyond their financial means. Now, this isn't an immediate decline, but it certainly may raise some questions and can definitely have an impact on your overall credit score. Now, before we keep going, I do want to dispel some myths that are out there, because one or two genuine inquiries for a pre-approval that say didn't proceed isn't going to suddenly destroy your credit score. And whenever I access my client's credit file whilst prepping an application, it's what's called a soft touch inquiry, so it doesn't leave a mark or an inquiry at all. Now, the next part of your report to have a look at is that for each facility that you have open on your report, it will show details like when it was opened, what the current limit is, as well as the repayment history on the account for the last 24 months. And any numbers that you see other than a 0 is an indication that the facility has been paid late. A 1 would be 30 days late, 2 would be 30 to 60 days late, and so on and so forth. And late payments and defaults are 100% a red flag for banks and can definitely impact your ability to apply with a particular bank until this is far enough into the future. Keeping an eye on this to make sure that all your repayments are up to date and that your credit score is looking healthy is the best way to ensure we're presenting your application in the best light. Now, if you're looking to borrow with a 5% deposit, a lot of banks will want to see evidence of what is called genuine savings. And essentially, this is savings that's been accumulated in your account over a 3-month period, and they'll want to see 5% of the purchase price. What this means is that, say you sold your car for 35 grand, certain lenders will not treat this as genuine savings until it's been held in your account for a period of 3 months or more. Now, it's important to note that this is not the policy held by all banks, and some will treat it as genuine savings immediately as long as it's from a genuine source. Some of you might be in the fortunate position that the bank of mum and dad are willing to help out, and there's actually one of two ways that they can do this. The first is through what's called gifted funds. So if their financial position allows, they can actually gift you cash directly to put towards the purchase of your home. The funds don't actually have to be transferred upfront, but they will need to be available for settlement, and the bank will need what's called a gift declaration in support of this. The second way is through providing a family guarantee. So if your parents own property and they've got sufficient equity, they can actually pledge their equity as additional security for your loan, meaning that you can effectively borrow up to 107% of the purchase price, covering the purchase price plus the upfront costs with no cash deposit required from yourself. Your parents aren't actually giving you any money directly, and they're not on the loan. They're just using their property as an additional security. It is important to note that they are providing what's called a limited guarantee, meaning that in the worst case scenario, they are actually liable for the amount they are providing you to as the guarantee. The strategy here is simple though. Once you've paid down your loan to 80% of the value of the property, we can actually request the bank to remove them as guarantor. The next way is one we spoke about earlier, but it is the First Home Super Saver scheme. And genuinely, this is one of the most underused tools available. If you're 12 to 24 months away from buying and you're not using this, it's certainly one to look into, because otherwise you're definitely leaving money on the table. Lastly, and this one's going to sound super obvious, but if you're serious about building up your savings position, make sure you pay yourself first. Automate your savings so that the day you get paid, you immediately transfer your desired amount directly across to an account you can't touch. Structuring it in this manner will ensure that your lifestyle habits don't take over and leave you with nothing saved each month. This is arguably the most important chapter, because your borrowing capacity dictates how much the bank will lend you based on your situation, and everything else tends to flow from this figure. The first thing to understand is that your borrowing capacity is not a fixed number. It actually varies bank to bank because each lender has a slightly different policy around how they calculate it. So your same situation could get you $650,000 with one bank and $720,000 with another. This is also one of the main reasons that people tend to use brokers, because a good broker will be able to assess your individual circumstances and find you the bank whose policy and interest rates suit you best. At a high level, how much you can borrow seems like a pretty simple equation. It's your income minus your expenses and your liabilities, but it's actually a little bit more complex than that. To start off with, let's look at your income. So if you're in a standard PAYG role and you receive a standard base salary, it's pretty straightforward. Most lenders will take 100% of this income into account. But what about if you receive things like overtime, commissions, allowances, or bonus income? With these variable types of income, banks will generally only take 80% of that income into account. And the main reason for this is to mitigate against any future risk of this income dropping in the future, or in the case of overtime, it's stopping entirely. Bonus income is similar in the sense that it's assessed at 80%. But as these are often tied to performance metrics, many banks require evidence of this being paid over a 2-year period for them to include it. Here's why it's not so simple though. Some banks need 2 years of bonus income evidence, others only need 1. Some banks will take 80% of overtime income, others will take 100%. And this is where a broker who knows lender policy inside and out is worth their weight in gold. So what about if I'm casual? Well, again, it depends on the bank, because some lenders can use your income straight away, but others most generally need you to have been working in a casual role for 6 months or more. And because this income is highly variable, many banks will shade this and only take the equivalent of your earnings for 48 weeks of the year. But there are still some lenders who will take 100%. Hopefully now you're starting to see the trend. It's highly variable. Last is self-employed. And as a general rule of thumb, most banks need you to have your ABN registered for an 18 to 24 month period. And at a minimum, you will need at least 1 year's worth of tax returns. Although some banks do need 2 years evidence for them to use this income. Self-employed income is a little bit more nuanced on the whole, and it goes a little bit beyond the scope of this video. But if you are interested, I did do a recent deep dive on self-employed income, and you can check it out by clicking the link to this video. On the expenses side of the equation, the bank will apply the hire of what's called the household expenditure measure and your declared living expenses. This is why it's a good idea to clean up your discretionary spending at least 3 months before applying so that this doesn't impact your borrowing capacity. Last is any existing liabilities, things like credit cards, personal loans, any buy now, pay later type facilities, and even things like any HEX or help debt. Simply put, the lower these are, the better. And with credit cards, the thing to be aware of is that the bank will assess you based on the limit of the card. So even if you only spend $500 per month, they will still calculate your ongoing liability based on the 10 grand limit. So just be aware you may need to reduce the limit or close the card out entirely, depending on your desired borrowing capacity. Now, there's 2 important things that I want to note here. And the first is that how much you borrow from the bank will directly impact your monthly mortgage repayments. So just because you might be able to borrow a certain amount with the bank doesn't mean that you should. You should always weigh this up against your personal situation to see and make sure that it makes sense without having a material impact on your day-to-day life. Secondly, it's always best to get your borrowing capacity figure from a broker. There's lots of calculators online, particularly from banks, but just remember, these are designed as a lead magnet for you to reach out to a bank directly. Now, you've probably seen that there's numerous factors that go into assessing your borrowing capacity, and that's where a broker can really help do the heavy lifting for you. If this is your first time speaking to a broker, there's a couple of things you should know. As much as we work with the banks, we certainly do not work for them. And legally, we actually need to abide by something called best interest duty, which is always prioritizing clients' interests above all else. So rest assured, we're actually 100% on your team. The second is that there is zero cost for our services now or into the future. And just like a good accountant, if you find the right mortgage broker up front, they should be with you for life. Now, the third is I'm a really strong advocate for reaching out to a mortgage broker as early in the process as possible. You don't need to wait until you're ready for pre-approval. And the earlier you start, the better, because we can better understand your situation and map out the most effective strategy to get you to achieve your goals. I've had clients who thought they were years away from buying. One conversation later, they were in a property within 6 months because there were strategies available they didn't even know existed. The roadmap only works if you start drawing it early, so don't wait until you think you're ready. Throughout the process, there's going to be a couple of key terms you're going to see come up over and over again. I've popped these up onto the screen. Feel free to pause and just familiarize yourself with them. Before I catch up with any clients, I'll generally request some documents so that I can do some pre-work into their situation. The types of things that I would need from my clients are last 2 payslips or last 2 years tax returns and notice of assessments if they're self-employed, 3 months of bank statements, basic photo ID, and details of any assets and liabilities that they hold. And at the end of the meeting, you really want to walk away having had the following questions answered for yourself. Things like, what is my borrowing capacity? What is the total funds that I need to complete the transaction? Should I be looking at a variable or a fixed rate? And what is the lender recommendation from the broker and why? Because once these questions are answered, you should be ready to move to the next step, which is getting your pre-approval. So once you've selected a bank, this is where your broker can effectively take over the process. We'll use all the documents you provided to us upfront to prepare and submit your application with the bank. To be very clear, there's no cost involved with getting a pre-approval, and once it's in place, it's valid for a period of 90 days. If you're still looking for a property at the end of the 90 days, it can usually be extended for another 90-day period, provided your circumstances haven't changed. A pre-approval basically serves as a document to confirm the bank have preliminarily assessed your application and based on everything you've provided to them are happy to lend you X amount of dollars. Now, to be very clear, it is not a formal approval and any offer you make on a property is still subject to finance, but it is your ticket to start shopping. Once you've got your pre-approval in place, here's exactly what happens from here. Step number 1 is searching for a property. It's always a good idea to set up some alerts on domain and realestate.com for your target suburbs and the price range that you're looking at. Start attending inspections, and it's always a good idea to let agents know that you've got a pre-approval in place. It signals to them that you're a qualified buyer who's ready to transact. Another thing to be mindful of is you don't want to be looking at changing jobs while you're actively searching for a property. Your pre-approval was issued based on your original financial position, so any major changes like this can affect your formal approval down the line. Step number 2 is making an offer, and there's generally 2 ways that you'll buy a property. It's either through what's called a private treaty or through an auction. Private treaty just means that you're negotiating directly with the selling agent. It's actually the most common way most properties are bought. Before you sign anything, make sure you get the contract reviewed by your conveyancer. It could cost you a couple of $100, but it could save you from a very, very expensive problem. And make sure you never sign a contract that you haven't had independently reviewed. If you're buying at an auction, it works a little bit different. So if you're the successful bidder, you sign the contract and pay your deposit on the day unconditionally. There's no cooling off period at an auction, which means your pre-approval has to be firmly in place and you need to do your due diligence before you attend the auction and place a bid. Step 3 is the exchange deposit and cooling off period. So once your offer is accepted, you'll move to the exchange. And this is the moment that the sale becomes legally binding on both sides of the equation. At exchange, you'll pay your deposit, which is generally 10% of the purchase price. And this will be held in what's called a trust account until settlement. Most states generally have a 2 to 5 day cooling off period, which is your window to complete your building and pest inspection if you haven't already. And just make sure that if you were thinking about pulling out during the cooling off period, you're generally going to have to forfeit a small percentage of the purchase price as a penalty. Your conveyancer will be able to explain exactly how it works in your state, so make sure you reach out to them first. Step 4, formal loan approval. This is where your broker converts your pre-approval into a formal approval. We submit the full application to the lender with the contract of sale attached, and this is where the lender will then organise an independent valuation of the property to confirm it's worth what you're paying. Now, assuming all that stacks up, formal approval is then issued. And this is the moment you can start getting excited, as it's all going to start to become more real from here. Step 5 is receiving your loan documents, getting your insurance, and any pre-settlement checks. So once your loan is formally approved, the lender will send through your loan documents generally within 48 hours of the loan being approved. Now, if you're purchasing a house, you will need to take out a building insurance policy. And this is to cover the property in the event that anything were to happen to it. And specifically, you need to make sure that your current lender is listed as the interested party. If you're purchasing a property in a strata complex, generally the building insurance is covered by the strata company. So you don't need to take out your own building insurance for this. In the days leading up to settlement, you'll complete your pre-settlement inspection. You'll get an opportunity to walk through the property and confirm it's in the same condition as when you agreed to buy, and to make sure that any inclusions listed on the contract are present. And if anything isn't right, make sure you get onto it straight away and let your conveyancer know before any funds are actually released. Step number 6 is settlement day, and this is the end of the process. This is where the balance of your purchase price will transfer from your lender across to the vendor, and the title of your property will transfer into your name. To be honest, there's very little that you'll need to do on the day, and your conveyancer will manage the entire process. And all you need to do is wait for that phone call that says, "Congratulations, your property has now settled," so that you can go and pick up your keys. So there it is, the complete roadmap for buying your first home in Australia. Hopefully now you've got a better idea of where to start, what you're entitled to, what it's going to cost, and how much you can actually borrow, and exactly what happens at every stage of the process through to settlement. If this video helped you, please share it with someone thinking about buying. I genuinely want to help as many people as possible. Drop your biggest questions in the comments below, and see you guys in the next one.